Okay, welcome everyone, and I think it's time to get this show on the road, as my late father would have said. I just want to welcome everyone, and I trust that everyone's navigating summer well. I can tell you if you're in Schuylkill County, the word navigating is a bit of a problem, I think, with much of Pennsylvania. Our recent flood activity in many parts of the Commonwealth have been problematic, particularly for my constituents, but for many others also. Commissioner Bloom had mentioned the fact that we should approve the minutes from our organizational meeting that took place on May 30th,
I'll make that
2018.
motion.
We have a motion from Commissioner Bloom. Do I have a second?
Second.
All those in favor? Aye. Okay, the minutes from the organizational meeting of May 30th are approved. Okay, we are the Public Pension Management and Asset Investment Review Commission. At the break, I discussed with our logistics organization, that's the Joint State Government Commission, that the transcript and the videotaping of these hearings will be available on their website for anyone to take a look at, and hopefully the information that we garner from these hearings will be important and it will be able to really improve the performance of the boards and the pension systems in the Commonwealth of Pennsylvania. From within the 6 months from our first organizational meeting, and I mentioned on May 30th, we are charged with delivering a report, and I believe that we have got experts, particularly with Dr. Ashby Monk, who will be helping us deliver that document. And as I mentioned earlier, we'll be meeting with him. And he will be testifying at the subsequent 2 hearings. Today's hearing particularly will be evaluating and making recommendations on improving investment fee transparency on alternative investments and implementing the Society of Actuary Blue Ribbon Panel on stress testing, two of the items that we have been charged with doing as far as Act 5 of 2018. I'd like to welcome my colleague to the hearing today. Representative Frank Ryan has joined us in the audience, and his accounting and financial expertise are really important for our body, and he delivers us great information and counsel on making important votes. And Frank, we're happy that you're here today. I'd just like to make a few comments. In today's world of increasingly scrutinized, complex, and litigious investment environment, we see improprieties that have at times resulted in tremendous personal financial loss, from events like the Enron scandal and Bernie Madoff, to market uncertainty and volatility that results in increased regulatory layers of reporting and oversight. We're experiencing right now a cultural shift from making not only sure that investments are not just suitable, but to a climate of greater fiduciary responsibility and liability for almost everyone that oversees the investments of plan participants. Investment advisors and others that are charged with overseeing the assets that will result in the payments that make up the financial future of retirees is a tremendous responsibility. The additional pressure that's being exerted as a result of the massive underfunding of many of these systems, and in Pennsylvania's case, tens of billions of dollars on so many governmental plans, puts the work that we undertake here extremely important. I'm grateful for the groundwork that has been laid so far from our Treasurer's Office and the support from our House staff to the Joint State Government Commission. And I want to thank in advance the testifiers that have been willing to share their expertise in various areas like transparency, costs, risk, alternative strategies, and more. I fully expect that this commission's work will give Pennsylvania's 2 largest pension boards the tools to shift their culture to that of world-class institutional investors and improve their performance if they choose. The time to implement strategies that will result in better alignment of the investments of professionals with the portfolios that they manage, and opportunities to implement a greater degree of scrutiny on fees and other forms of cost and compensation that are being paid is now. I'm happy with the spirit of cooperation that exists as we commence these hearings. I'm certain that we can all gain a good bit of additional knowledge from the experts that will testify. And from what I've seen so far, the desire to improve performance is being taken very seriously by everyone. Ladies and gentlemen, we have a huge responsibility that comes with a lofty goal. Billions of dollars of savings for taxpayers in Pennsylvania. I'm hopeful this commission will produce a product that will be effectively implemented and serve as a model for others who seek to improve the results that the citizens that pay into these funds expect. These important instruments of retirement security represent so much for the hardworking families that are participants. To my colleagues, thank you in advance for your dedication to this work. Prior to the hearing of our first testifier, is there anything that my fellow commissioners would like to add? With that said, we've got someone from Oxford waiting on the line, and in about 4 minutes, Dr. Ludovic, and I will get his name right by the end of the conversation, I'm sure. Dr. Ludovic Philippou will be testifying, and he has done a tremendous amount of work in the area of transparency and private equity.
Hey, Mr. Chairman, if I may, while we're waiting for a testifier, I just got a text from one of those hardworking beneficiaries, my mother, who's following our proceedings with great and personal interest. A reminder to me that this is, in the end, about strengthening the system for people like that, and that to the degree we can do a better job of managing, investing, and preserving their resources, it establishes these systems going forward for what they were intended to be, which is a promise of retirement security. You said the key word when you talked about transparency, which is alignment. There are lots of good reasons to be for more transparency, and there are lots of good examples for how we can do that, I think, in a relatively pain-free and low-cost way. You mentioned Bernie Madoff. There's the issue of what we don't know. There's the issue of comparing apples to apples, which if we're doing a good job at managing money, we can't do without making those comparisons. But there's also this issue of alignment, which is our interests, our beneficiaries' interests, my mother's interests, aligned with those of the managers. And without knowing and understanding, as a first step, the compensation structure, almost impossible to answer that question. So as I said earlier, I think transparency is not a nice to have, sort of softball in the middle of some other harder topics. It's something that goes to the very core of what Act 5 aimed to do, which is to create a sustainable and responsible system going forward, depending for at least $3 billion of that on the work of this commission and the result that we can achieve. So share your hopes and aspirations, share your gratitude to the staff, and your view that this can be a useful and cooperative exercise.
Thank you very much. You know, I think that with some of the previous conversations we'd had with different testifiers, you know, I heard when we're testing a hypothesis that we are overpaying for some of the services that we receive for these pension funds. But oftentimes it has come back and said, well, you don't know. And I think this hearing is so very important because transparency is imperative to understanding what we are doing relative to other systems and whether or not we're getting the best deal. So as we've mentioned, we're going to have testifiers here today that talked about efforts that they've made or that they have seen or studied as far as transparency and how that results in hopefully better performance. So thank you very much. As I mentioned, the work that we do here is important for the people that have served and expect to be able to live in retirement, and the Commonwealth upholds the promises that they've made to them. I do take it very seriously, so thank you. Okay, with that said, we have got our first testifier on board. We appreciate Doctor, you testifying and bringing your expertise to this commission. The work that we do here in Pennsylvania is very important. As we've mentioned earlier, we've got a pension system here that is substantially underfunded, and the idea that we might be more transparent in our efforts to perform better is really important, and we appreciate the fact that you're testifying here today. I am Representative Mike Tobash. I'm the chair of the commission. I sit beside our treasurer, vice chair, Torsella. We've got Commissioner Bloom, Commissioner Torbert, and we've got a substitute for Commissioner Gallagher today in Steve Nichols. So thank you again. We are anxious to hear your testimony.
Thank you very much. Thank you for having me. I assume the sound is good and everything is working.
Yes, we can hear you loud and clear. Thanks.
Excellent. So I was told to start by to set up the scene with an example of what a private equity transaction looks like. So basically, we see this little girl there who we're going to call Alice. Alice is going to have an idea. She thinks there is this house, which is a good investment. The house is for sale for 1 million. And Alice is going to set up a company to buy the house. And that company is going to be the one borrowing a lot of money to buy it. It's here in the example, it's borrowing from the bank 82% of the money needed. And then these two hats here represent the people who are going to give the equity, so the cash to buy the house, the cash. This would be like the pension funds. So then this house, which is now set up as a company, is going to have 82% of debt that the house needs to repay, not Alice, and 18% of the equity, which is given by these pension funds there. And Alice is going to control this company. So Alice is, you can imagine like a 6-people board for this house. And Alice and her employees would have like 4 seats out of 6. So she has a majority, she controls the house, she calls the shots, she's the one managing this place. Even though it's not her money, right? So other people's money, there is the bank and the pension funds here who gave the money. So Alice is going to try to make this house look better. She's going to try to make as much money as possible out of this house. So she's going to maybe increase the size of the house, clean it up, find a way to rent it for a higher price. And 5 years later, 4 or 5 years later, that's usually the holding period for these transactions, Alice is going to organize the sale of the house, and she sells it on this example for 1.2 million. It is assumed that some of the rent was used to pay back some of the loan, and so there is 600 left to be paid to the bank. So in this example, quite a lot of money goes back to the pension fund, and Alice charges 2 types of fees. One is a management fee, the 20K, it's a flat fee called management fee. And the 80K was a proportion of how much money she made on this house. So it's basically 20% of the gain that the pension funds had realized. So she gets 80K of a performance-related fee, which is called carried interest, and 20K of a flat fee on this transaction. So just to make sure that we know who's whom and what kind of, how generalizable this is, this setup is basically what would be used for any kind of private equity transactions, and private equity is widely defined. So a lot of real estate investments happen this way, but also infrastructure investments. So there are many airports in the world that are owned by private equity funds. And so these airports are bought with a bit of money from pension funds and a lot of money borrowed from banks and other lenders. Of course, corporations would work the exact same way. Alice would think that Hilton Hotels is a good company to buy, and then Alice asks pension funds for money and banks for money, and then with that money, she organizes the purchase of Hilton Hotels. So forests, etc. Transactions happen this way. So Alice here is a general partner, a GP. She's a fund manager. She's the one who's organizing all of this. Again, it's not, you notice that it's not her money. It's the pension funds and the bank. She borrows most of the money used to purchase the assets. And she's the one collecting these 2 sets of fees. The hats there are the LPs, limited partners. These are the pension funds or sovereign wealth funds. These are the two main contributors to private equity. The house is a portfolio company. That's usually how we refer it to. Then there is the bank, and there are some people intervening to improve the house. So that's what a private equity transaction looks like. This is how a lot of companies are bought and controlled. So I've put a few companies here that you would probably recognize. And it's also to show you the breadth of companies that are purchased, grown, and sold in that fashion. So you will see a lot of like food restaurant chains like Papa John's, Burger King. You will see like even hospitals, like Hospital Corporation of America was bought in the exact same way. So 20% of the money came from some pension funds, 80% was borrowed. Then this company was held for like 4 years and then sold again after that. And in the meantime, people tried to make as much as possible. You have schools, Cirque du Soleil, textbooks, etc. All these companies have been owned by private equity firms. So it's literally thousands and thousands of companies. So the question we are interested in today is whether there is alignment of interest or how relaxed are we with pension funds giving money to Alice to do these sorts of transactions. So the first thing to emphasize, which I already mentioned, is that Alice controls the board of the company. She calls the shots. Okay, it's not her money, but she's the one who organizes the whole thing. She controls the board. She appoints the CEOs. She's in charge. And both Alice and the pension fund, they both want that the house is worth as much as possible, because the more the house is worth 5 years later, the more Alice is going to earn in terms of carried interest. So here in the example, it was 80K, but if she would have sold the house for just 800,000, Alice wouldn't have got this 80K. She would have got only 20K because she wouldn't have made enough money to get the carried interest. And if she would have sold the house for even more, she would have made even more money. So people traditionally would say that this is perfect incentive alignment. We see that Alice wants to be rich, and the more she generates cash for the pension funds, the richer she gets. So we should all be very relaxed about this whole thing. So that was certainly, and still is for a number of people, the common belief. Now, what I've been emphasizing in my research is that it is not that simple, because when Alice is in charge of something with someone else's money, she has temptations. So some of the things we do observe, hard to quantify, but we observe it. We know it. It's how it works. Alice, for example, could very well say, you know, I'm buying a private jet, and then I'm going to use that private jet to go and visit companies. I'm going to go and visit this house, these airports, these Hilton hotels, these Toys R Us that I bought with this pension fund's money. And she invoices the private jet, her stay in potentially fancy hotels, etc., to the assets that she controls. So imagine that Alice would control the board of Hilton hotels, and then she would say to the CEO she just appointed, okay, here are all my expenses. I flew with a private jet, I stayed in that fancy places, etc. Just refund me for all of that. So that's one aspect, like all the expensing, where like she's the boss and the one expensing, deciding on how much to expense, etc. But probably potentially a bigger concern is that Alice seems to be hiring herself for some kinds of like consulting services and things like that. So Alice sits on the board of his company, and then she tells the CEO, oh, by the way, last week I worked a lot on like this Hilton Hotels organization, and it was a lot of hard work, and here's my invoice. You should give me $10 million for that. But she could decide that it's 100 million, or she could decide that it's 1 million. What is important to recognize is that there is no regulation here. It's an unregulated market. So Alice can do whatever she wants. She can say, you know, like last week I was thinking hard about that stuff, and, you know, I think you, my employee, should just give me $10 million from the cash tilt of Hilton Hotels or the like to pay me for what I did. So that's tricky. That's potential for serious conflicts of interest. And again, it's because it's unregulated, like on a listed company, you wouldn't, as a board member, be able to do these sorts of things. You wouldn't be able to really like decide on, well, you wouldn't really be able to consult, to do consulting work for a company you sit on the board of, and let alone decide on how much to pay yourself, etc. In private equity, there is no rules, so this is allowed. Anything can happen, and it's down to Alice's goodwill. So one response of the industry is that people are good people, they are ethical, and they will never do bad things. And if they do bad things, then the pension funds would be very mad at them and they would never give them money anymore. And so these guys would die. And so then they should not do it. So they should all behave, etc. The problem is that the pension funds historically have not collected this sort of information. Hence the question, how can they discipline Alice if they don't collect the information about how Alice behaves? Since 2012, it's important to know that the SEC has brought some discipline. It's quite new, it's quite small. It has had an effect. Will it last and will it be effective? We don't quite know. But at least the SEC has said, even though Alisa can do whatever she wants, we want Alisa to tell the pension funds that she may be doing that kind of thing. Okay, so it's not really even saying how much she can charge or things like that. It's like, if Alisa makes clear that she may be charging stuff to pay herself, etc., then we want her to at least say that to pension funds. So this is where the state is in the US. Rest of the world, there is nothing. There is no regulators looking into this thing. So one question is, who cares about any of that? Who cares about what Alisa does with pension funds' money? Some people even question, should the pension funds themselves know how she behaves? Maybe they don't need to know. Some people think, maybe, there is a question that maybe the pensioners should know how she behaves, not just even the pension funds, because it's their money. And maybe the taxpayer needs to know, because if a fund is underfunded, then the taxpayer will step in, and so they may want to know how Alisa behaves, what she does with the money, if she flies private jets and invoices that to pension funds and the like. And the reason why people say who cares is because they say it's all about net returns. So if Alice has delivered good returns, we don't need to know the recipe. It's all cool. The problem is, so first there is a question of, for some people, of ethics and fairness, which is that maybe Alice had said, I told you I would give you more than 8%. I gave you 10%. So whether I kept 10% or 20% or 50% for myself, then you should not care about that because, I gave you what I promised you. But some people may think, well, if you delivered like 10% return and charged 7% of fees a year, then I may not find that deal really fair, and I have issues with that, and I want to know more about it. So that one counter argument is that, we may want to know because of some ethics issues. The other reason is, and which is purely economics, is that the future may be different from the past. So if Alice in the past might have managed to deliver returns that are decent enough, but if she behaved in a way that is where she's conflicted, well, if the future is different from the past, then she may keep on charging high fees with lower expected return going forward, and then we would have an issue suddenly. And so we may want to monitor these things. And it is also not that clear that Alice has delivered good returns, which is a pretty complex topic that I will not have time to get into. So I want to show you like a way that pension funds have reported fees and costs so far. The important thing to notice is that the pension funds are also pretty conflicted, because the people who works in a pension fund in the private equity team, they don't want to say that Alice is misbehaving or that they are concerned about Alice's behavior, etc. Because the people in the pension funds working in private equity, if they scare people with these kind of things, then we stop investing in private equity and they lose their job. So they want to say that everything is all right and we don't need to worry and everything is under control. And interestingly, for a long time, so the few pension funds that did report the fees they were paying to Alice were reporting numbers that were incredibly low and actually just not believable and fairly silly. So you see here an example from CalPERS. The last 2 years, they they reported fund by fund how much they had paid. You see some years where they say they didn't pay anything. You see some years where they report like $300 for the entire year for $200 million allocation, etc. These numbers are clearly incorrect. And so for a long time, well, so far even, pension funds have always said, look, if you look at the fees we pay, it's not much. So it's all cool. The returns are quite okay. The fees are low. So leave us alone. It's all, we don't need to look into what Alice is doing. The problem is that these fees are not correct. There are many of them missing. And one of them is carried interest. So the 80K you saw in the first exhibit, a lot of this carried interest, so the carried interest is typically not reported, never reported. And that's a big chunk that is missing. We think about 2-3% a year. And then there are the fees charged to the assets. What I was talking about earlier when Alice is charging directly like for consulting fees or transaction fees, all kinds of things like that. This is not reported by pension funds as a fee that has been charged. But obviously, if the pension fund owns a house and Alice keeps some of the rent for herself because she did some consulting work, that's a fee. And that's not counted as such because the pension fund says, but I didn't pay Alice for this amount. But Alice took the amount directly from the asset. So you did indirectly. So there is this, this is quite a big chunk as well. And there are all these fund expenses like the private jet and the like, company expenses, etc., for which we actually don't know how much it is. Nobody has access to this information. And there are all kinds of other fees. So I wanted to briefly show you what that looks like on a transaction. So this is the example of Harrah's Entertainment. And this is the sorts of agreement that then when people like Alice, so here in this example, it's Apollo and TPG, they buy a company, Harrah's Entertainment, with someone else's money, and they sign an agreement with a CEO that they just appointed saying, you, the CEO, need to give us money directly from the cash out of Harrah's Entertainment. And the reason for that is that we're going to give you services. And if you read the services here, it basically says that, from time to time, we may do stuff. Okay, so I translated it as, we may do some work from time to time. Then that section continues and say, we will devote time and effort that we deem reasonable, but we have no minimum number of hours we need to do, etc., against this contract. So they basically decide how much work they'll do, and this is a translation that is one of the teacher, but when people tell me they will not do any minimum number of hours, usually it ends up close to 0. Then the section 2, so that's the only section that describes like what is it they're going to do. And section 2 says how much money they're going to be paying. And this is to give you some orders, concrete orders of magnitude. So for Harrah's Entertainment, they would say, for this kind of vaguely defined fees that for services that we may or may not perform, we're going to take $200 million out of the cash deal of Harrah's Entertainment to go to us. So that's, again, that's the money that otherwise would have belonged to the pension fund. And on top of that, like you cover all the costs of acquiring the companies, etc. So it's really $200 million on top of what it costs. And on top of what the pension fund is already paying in terms of management fees, etc. Then the section 2B would say, and I'm also going to like monitor things, and for that I take a fee of like 30 million a year. So again, irrespective of how much you decide to work, you will get 30 million a year paid from the cash deal of Harrah's Entertainment. And then this section C says that actually if you do something, which is like you do some financing, refinancing, recapitalization, etc., then you're going to charge extra, but you just don't say how much it's going to be. You say, I'm going to take some more from Harrah's Entertainment if I decide to do some work. And then there is this section 4 as well that was also a bit in the news recently, whereby they say, oh, and by the way, if we stop this contract, then we're just going to get the fees for the next 8 or 10 years, all the way to year 10, that we would have got if we wouldn't have stopped the contract. So basically, if I stop monitoring this company and I sell it, I'm just going to charge what I would have earned in terms of fees for the next X years until like 10th anniversary of this contract. So these are examples which I'm going quite quickly through, but to give an idea about like the sorts of things you can observe, whereby the money of pension funds is taken by the GPs, and the pension funds do not track that, they don't know, and the GP is fairly conflicted in terms of how much they're going to charge for what and so on. So for the case of Harris Entertainment, actually, they took a total of $300 million. The company ended up bankrupt, so pension funds lost all of their money. But the GPs made $300 million in just monitoring and transaction fees on this transaction. Toys R Us, Energy Futures, same story. It's about $500 million of fees that were taken on these companies who ended up bankrupt, where the LPs didn't get any money. Of course, fees are also charged for companies that do not get bankrupt. And for a long time, nobody knew about these numbers. So it's some research I've done recently. The SEC stepped in, etc. That said that these kind of things were happening and gave some magnitudes to these numbers. And the GPs now responded by saying, "Oh yeah, we were doing these things. Yeah, it was not very nice, but and this is actually what a big GP said. We as an industry have moved on now." The problem is that if you do something for like 30 years where you've been conflicted and done things that you are not quite supposed to do, it does raise an issue of like how much trust can you put in an industry where this has happened, and how much this argument of saying, you don't need to know the recipe, it's all cool because the returns have been okay, that may raise concerns, and it may then trigger some desire to be collect more information and improve transparency. Now, the thing is that transparency can bring you quite a lot more than just knowing. There is the ethical considerations again, the asymmetric things, also fees I don't have time to go over, but the issue is, if pension funds keep on saying that they don't pay much fees, 1.5%, while in fact they pay something probably close to 6 or 7% a year in fees, if they keep on saying that it's just $100, $200 million a year they give to private equity, when the true numbers is like $1 billion a year, the problem is that they don't make their life easy because they don't have any bargaining power with Alice and other GPs, because the other guy says, you officially report low fees, you officially report an okay return, so I'm not going to make any concession on the contract. I will continue to behave as before. I can charge as much as I want and behave just as before. So if the real information is there, if we have a correct benchmarking, a correct idea of the risk and return of private equity, a correct idea of how much fees has been paid to get to that performance in the past, an idea about how much fees will be charged in the future in an environment where expected returns are lower, which is it's a consensus, then we would be in a better position, and we would have pension funds that are better equipped and have more bargaining power with GPs. And actually, the recent efforts, like the research I conducted, the SEC efforts, etc., the lots of noise in the press, have actually started to move things in the right direction. And that has benefited the LPs. So the LPs for a long time have tried to put things under the carpet in order to nobody to be worried and for them to be able to continue investing in private equity the same way as before. But now that it is out there, then actually they benefit from it because they have a bit more bargaining power here and there. It's still very limited because there is limited transparency, but it has been going in the right direction. So if all the information is out there and things are transparent, I think the pension funds could manage to get fees that are mainly performance related rather than being unrelated to performance. I think they could get less fees that are like purely discretionary. They could have more control about where the money is going. And that I think could be extremely helpful to them. So to summarize, I think that the pension funds for a long time have been resisting transparency because they didn't want to scare people. They didn't want, but my interpretation, they didn't want to make people say, oh, we're not going to do this kind of investment. So that's it. We shut down the private equity division. So the private equity division, who knew a bit about these things, then had an incentive to not say anything and hoping, nobody would know. It's now in the open. It has started to be in the open. And so now they cannot really hide, but it's quite remarkable how many pension funds still try to hide and persist in these ideas that it's all good, the returns are okay, so just leave us alone. It's all confidential. We're gonna scare people, and then we're gonna take our money anymore, etc. I think that's not the right attitude. I think the pension funds will gain a lot more by being forthcoming, by being vocal, by saying these contracts are not right, and we want different contracts. And the regulator can help with that. The legislator can help with that by saying, but making like investing conditional on having proper contracts or at least proper transparency, that we know what is being signed and how much has been charged and so on. I'm aware it's extremely fast, but hopefully you got a flavor of what I was trying to cover.
Thank you, Doctor. Are you able to go with split screen so we can see your face for the question and answer portion of the next portion?
I don't know if I can do split screen, but I could stop the sharing. Because you have the slides with you, right? So,
excellent, and welcome. Now we can put a face with a voice. Well, welcome. And I thank you again. So we've got a number of questions, and I'd like to get started here, if it's okay. So returns for private equity are alluring for sure, and many times they're claimed to be high. Comparatively speaking, with other investments that are more transparent and measurable, fees for private equity, where are you benchmarking fees within the private equity space? And then returns.
So again, there's so much hidden. We don't really know exactly how much is being charged. And then there is a problem of we don't even know how to define a fee in private equity. Because, for example, in the example of the house with Alice, if Alice is actually doing real consulting work, and then she charges the house for it, she takes money out of the rental income for consulting work, then Alice could say, well, that's not a fee, because if I would have hired McKinsey to do the job, you would have paid it and you would have called that an operating expense, and you wouldn't have called that a fee. So why would my consulting fee be a fee? It's an operating expense. So there is a difficulty to even define a fee in private equity space. And so that's one issue. All the expenses are also like, you would need to define excess expenses. Is a private jet necessary, or is it a perk, etc.? So is that like an indirect fee, yes or no? So there are a number of things that we don't know. We don't know the numbers, and even if we knew the numbers, it would be a bit hard to draw a line on. Okay, that's a proper operating expense. That's like arm's length, and this isn't. But there are a number of them that we are quite sure we can quantify. So the ones we can quantify add up to about 6% a year. So when I came up with that number in my research, people were screaming because of course officially people were reporting 1%, 1.5% of NAVs. Now there is a near consensus that people have replicated the results, etc. So people agree that we are talking about like 6% a year, which is an extraordinary number. Other investments out there, if they charge 0.5%, 1% would be seen already as an expensive investment. So 6% is unheard of. It's like magnitudes away from, and it's really the most fee-generating industry, which also means that it feeds a lot of people. So when you have a consultant telling you where to invest, the consultant, if they tell you to invest in Vanguard, they're not going to make much money by giving you this advice. If they advise you to invest in something that gets 6% a year in fees, they have plenty of room to get like all kinds of kickbacks, directly or indirectly, with these sorts of investments. So when you have an industry that generates so much cash, so much fees, there is plenty of dough to feed a lot of people. and which means that you may not always get the most accurate information. And then you have like pay-to-play scandals and all these things because the amount at stake is also like so important. So they have charged like this kind of amounts. Going forward, if you look at the contracts, if the returns are lower, it doesn't. If you simulate it, the fees would stay at this kind of level. They would be like 5%, even like in a much lower interest environment. So the fees are going to bite a lot more going forward compared to what they have bited in the past. And so that's one thing that I've been emphasizing is very worrying. And nobody really like puts that on the table, because right now everybody is just saying, oh, these guys have high returns because they are so risky. Their past returns are good, and so it doesn't matter. I don't negotiate fees. What matters is net of fees, and so I'm all cool. The problem is if the expected returns are lower and your fees are high, the future is not going to be like the past. So your net of fees returns in the future are not going to be the same. So that's a big worry. In terms of past returns, which is the only thing we can measure, there is an entire marketing and industry showing numbers that are incorrect, like the 30% of Yale endowment or these kind of numbers, like that are like completely fake. If people measure returns properly, you have numbers that are around 12% a year at about any horizon, really. If you take past 10 years, 20 years, 30 years, you'll be like at 12% a year. For like leverage buyouts. Venture capital is very volatile, so it's a bit more difficult to measure. Real estate is much less. Infrastructure is in between. But leverage buyout, which is the largest chunk, so like the Toys R Us, Hilton Hotels, etc. This is about like 12% a year in the US and Western Europe. So it's not a bad number. But then it all depends on how you're going to benchmark it. So if you say, for a long time, the industry said, oh, look, compared to the S&P 500, it's a lot higher. The problem is the S&P 500 is just like one index that is influenced by like 5 stocks. So, for a long time, the S&P 500 was way below private equity, but it was also way below the average stock in the US. And now the S&P 500 the last 10 years has been doing extremely well, thanks to these like 5 stocks. And now people are saying, oh, no, we should not use the S&P 500 as a benchmark anymore because like these 5 stocks are just like, it has nothing to do with private equity. So now people say, oh, you need to use like MSCI World. And it just turns out that MSCI World is also one of the worst performing indices over the last 10 and 20 years. So if you're trying to choose like the index that suits you best, then you will find that the returns of private equity is 3-4% above that index. So when people use MSCI World and measure things properly, they find that private equity buyout is like 3-4% extra a year. But if people were using things a lot simpler, like the average stock in the US, out of like the 5,000 stocks out there, like just the average stock performance, private equity performed just exactly the same. It's 12%. So at about any horizon in the US and Western Europe, the average stock has performed 12% a year. So then one needs to be aware of that as well, that it's going to be a bit benchmark sensitive. But the bandwidth is, if you want to be as optimistic as possible, then we are talking about 3-4% above a carefully chosen benchmark. If not, it's equal to the average stock market, to the average stock. Now, then you may want to say, well, but there are all kinds of risk. It's costly. I have all these complex contracts I need to enter into. I need to do all this due diligence. The monitoring is complex. I'm giving like my car keys to someone to drive. So that's not the same as just giving money to Vanguard. And there is also the fact that it is so highly levered. So when you have a 82% leverage on a house, you know that you don't have that much margin for error. So the risk is not the same as if you had just bought a house only with equity. So people may say, I may need a premium compared to the public market because of all this leverage being used. I may need a premium for committing capital that you can call whenever you find suitable. So I may need all kinds of premium. And so people in the past have said, well, 300, 500 basis points of premium would be okay. And the problem is that, again, if you take the average stock, the 300, 400 basis points, so 3-4% premium hasn't been there. And even if you choose the MSCI World, then remember I said it's 4% premium. So if you say because of a risk I need like 3-4% extra from private equity, then in the past it means it just didn't give you anything other than what you required, given the risk. So then the question is, how could it be better going forward when people are just piling up in this asset class, signing contracts that are even like pretty wild in terms of like giving the car keys to the GPs and the like. So this is where the concerns are, and this is why I think that the LPs should be really vocal about asking for more transparency and getting more bargaining power on their side, because right now all the bargaining power is on the fund manager side, and it's partly their fault, is because they keep on trying not to show the real numbers for returns or choosing the benchmark so that they don't get in trouble and so on and so forth. And so you can see also how remarkable it is, actually, the performance. Warren Buffett, one of the richest guy in the US, has a performance after fees of 19% over a long time. Private equity at 12% after fees and charging 6% plus fees means that the average private equity guy out there has performed as well as Warren Buffett before fees. So this is how much this industry manages to generate in terms of money. They are really extraordinary people. They are like really extraordinary professionals. But the point is that they have kept to themselves most of the surplus that they have generated. And the LPs have tried to hide that fact so that they don't get in trouble. Again, if you look at the real numbers, it has not been a catastrophe in the past. It's not like, they lost tons of money, but it doesn't look like particularly exciting, even if you're trying to be optimistic. And the amount of fees that have been transferred can raise some ethics or fairness questions. And going forward again, with a lower interest rate environment, lower expected returns, then you could be nervous with a balance of bargaining power between these two parties.
Very good, thank you. So I understand 50 basis points versus oftentimes 500 basis points for private equity. And oftentimes performed well, but benchmarking is really critical in understanding how they're really performing. What about the idea of communicating rates of return that are midstream in some of these investments, internal rates of return reporting? Do you see any issues or problems with that, the way the returns are communicated in the interim to these pension systems?
Yeah, so it depends a bit on the shape of the cash flows. It depends on the type of funds and which funds, etc. But indeed, there has been in the past a lot of, I call that fake numbers with IRs. It's on fashion, so people that enables people to understand quickly what I mean. These internal rates of return are not rates of returns. Sometimes they're not too far, and sometimes they're like miles away. So for a long time, people said, oh, look, Yale Endowment got like 30% annual return thanks to private equity. They were quoting an internal rates of return. There's absolutely no way Yale Endowment earned 30% return in private equity. And people kept on citing this number. And I've shown them that if it was true, Yale Endowment would have a GDP of the US. And clearly they don't. They are very rich at Yale, but they don't have a GDP of the US. And so you have these numbers that are like really fake, and people keep on like showing them in presentations and the like. And I think that also then works against the pension funds. We see things cited in the press like top quartile private equity funds delivering 30% return, 25%. KKR since 1976 has delivered 25% return. None of these numbers are true. These are internal rates of return. They're not correct. So that's part of the issue, and that may not be what exactly you have at hand right now, but there is a lot of talks about having private equity in 401k. So you can imagine that if institutional investors have been fooled or fed that kind of fake numbers for a long time, what would happen if retail investors are allowed to absorb this marketing material? So there is a big problem with internal rates of returns. There is no alternative that is perfect. And so that's why always people say, oh yeah, but your alternative is imperfect, so I'm going to stick to my internal rates of return. There are no alternatives that are perfect, but there are alternatives that are a lot better. And so the more we encourage people to report in terms of things that are like public market equivalents with different benchmarks to see the sensitivity to benchmarks, etc., then yeah, we would have a much better idea about how well the funds are doing. There is also the issue that when you have a private equity program, most of the investments are self-valued by Alice, like the GPs. And so when you have a program in private equity, it's not rare. Like the average pension fund in the US would be in a situation where they gave something like 10 billion to private equity. They got 10 billion back. And they have a reported 5 billion of assets that are out there. But we don't know if, is 5 billion is a right number, not the right number. So that's always very hard to benchmark private equity. Even if you use the right metric, you also have the issue of all these things out there that you don't, you cannot be 100% sure are worth what they're officially reported.
Thank you.
It's all the extra inconvenience of investing in private equity. So that's why usually people would want to see a better delta in terms of return.
Thank you. I hear you loud and clear. So the internal rates of return deserve some scrutiny oftentimes within these funds. We're going to be hearing from ILPA here shortly. Are you familiar with their template?
Yeah, very well. I helped them to set it up.
So you think it would be helpful? I want to open it up to other questions from other commissioners. Vice Chair Torsella.
Dr. Philippou, thank you. Interesting presentation. As I understand your argument, it's that the full picture of all costs that are ultimately borne by the funds and real returns should be more visible. I want three questions about that. Number one, are there meaningful downsides to doing that would outweigh the economic benefits of doing that, both in terms of evaluating alternatives and getting some leverage? Two, you showed California as an example. Aren't they now in some other states starting to disclose more, for example, of the fee in terms of the carry? And then maybe most significantly, there's a school of thought that because private equity is time limited and because the LPs usually make money, as one of our funds here said, that the fees are effectively zero, that because all these fees are taken out of returns, that essentially you can't determine the fee until the end of the investment, and that those fees, unlike in a sort of ongoing public equity account, those fees effectively are zero and are really it's simply the net return that matters. I wonder if you could briefly tick through those three. Thank you.
Okay. The first, I think I've got them all. The first one, was it on the downside of being transparent?
Yes.
Yeah. The downside of being transparent, I think there's a lot more upside, but yeah, there are some downsides. So we have seen recently in Kentucky where their pension fund went bankrupt, and then the legislator in Kentucky was very upset, and they said, we will not allow the state pension fund to invest in any fund that doesn't sign like the code of ethics of the CFA Institute, which is like an industry body. Mm-hmm. So you would think it's a pretty lower bar, right? It's just somebody saying, I'm just going to behave ethically, and it's not even binding, and it's like, it's just like, and it's a code written by the industry. And you have a number of hedge funds and the like that just said, no, then we don't want money from Kentucky because we don't want to sign a code of ethics. So, I don't know. So you can say, oh, but then that's a loss because then we cannot invest with these people anymore. But my sense, my gut feeling would be maybe these are not the people you want to invest into anyway. So
you want to invest with someone who won't sign that code.
If they were good, maybe, To be clear as well, there are some private equity fund managers that are very clear about conflicts of interest of the kinds I've mentioned, and then say, we don't engage in any related party transactions because that opens room for conflicts of interest, etc. So they should be encouraged. There will be people that would be happy, to sign up. Just there won't be too many right now. So there's a bit of a coordination issue. So the SEC is currently helping with that, so that helps. But yeah, and the ILPA is crucial because you need everybody to coordinate. If you were only Pennsylvania saying, I'm going to put like some very strict rules, then it will be easy for the industry to just say, well, then we're just going to ignore 2 pension funds in the US and that's it. We can move on. It's not a big deal. So that could be the downside. But again, if the fund managers are good, ethical, and the like most of them say they are, then it shouldn't be a problem for them to communicate information. It's like when pension fund says, I cannot tell you my return, I cannot tell you my fees, etc. You say, but what's the problem? If you tell me, if you're right that everything is as good as you say it is, then what's the problem with sharing that information? It shouldn't be an issue. So it's an issue only if the numbers are not quite what you told me they were. In California, indeed, so I didn't have time to go over that. Huge difference, and things are changing, but it's just like 1 year ago, something like that. So most of my summer of last year, I spent with the Financial Times and some people sitting on the board of CalPERS, etc., pushing CalPERS to confess that the numbers they were reporting were not correct. But there was a lot more there. I made some back of the envelope calculations, which I gave to the Financial Times, which ran a very big story on there is 5 billion of fees missing at CalPERS. CalPERS collected the information over the next 6 months, came up with the exact number that I had. I had minus $100 million out of 5 billion, but I had calculated at the back of the envelope. And so now we have CalPERS reporting a lot more. It's still not everything, but they're reporting a lot more. And that is a very long effort. We've been with a few people working on the CalPERS case and California in general for like 3 years until we start seeing an evolution. And as far as I know, CalPERS didn't go bankrupt for having shown these fees, right? So this argument that it's a catastrophe if you show anything, well, CalPERS is showing them. As far as I know, they're still up and dancing. So that didn't change anything for them. So that doesn't kill anyone to show the real numbers. But it took massive resistance at CalPERS, absolutely incredible, the amount of resistance. And again, I think that will benefit them in the long run. The argument of the fees being out of the returns, yeah, I find that fascinating. Vanguard could decide that instead of giving you the dividends of the stocks they bought for you with your money, they could just keep the dividends and tell you that then you don't need to pay any fees, right? So any fees, any dividend that would have been paid to you, Vanguard keeps it and says, here you go, and don't worry, I'm not going to charge you any fees. It's a very weird argument, I must say. And it was one of the, I heard it recently. It was one of the first time I heard that argument. People have always tried to minimize fees, but to say they are zero because I have positive returns and the fees have already been taken out. Again, the picture, like I said, the picture at CalPERS and most pension funds in the US is it's 10 billion has been given to private equity, 10 billion returned, 5 billion still out there, but we think is worth hopefully close to 5 billion indeed, for a 4 years holding period, which means it's an 11-12% return. And they have charged in terms of fees something like another 5-10 billion, something like for that situation. So it's quite important to know, because you may say, okay, it's fair, I just got 10-11-12% returns and that's good enough. Yes, except the 5 billion of returns are not paid yet, and we don't know exactly, how well they're valued. But the fact that somebody took 5 or 10 billion to deliver that is actually an interesting piece of information, because you may think it was not quite balanced. And if you going forward, again, there would be less money to be distributed to the pension funds, then the fee bill is going to be a lot higher. And if you have given full power to people, then they can do whatever they want. They can open the cash tilt of all the companies that you indirectly owned and take the money out of there. So I'm sure most of them won't, but if there is lower returns and less income, maybe people can be tempted by this thing. So it's very strange, this world where people have written contracts, but just let people do whatever they want.
Thank you very much. So we want to keep things moving here. We're getting up against a time deadline, but Mr. Nichols, you have a question?
Yes, thank you. I was reading an interview you did earlier this year in Private Equity Laid Bare with Robin Powell, and I was trying to quantify just the scale of the problem with regard to what you referred to as tunneling, which I gather is the same as all these fees and added expenses. And you were quoted as saying there isn't tunneling on a massive scale, but it is happening and the amounts involved are not negligible. And I'd just like to be able to put this in perspective with regard to what you're shedding light on, which I think is extremely valuable, as to just how much of a problem it is in the industry when you make that quote.
So I went through like 30,000 pages of SEC filings because it turned out that like at least two fees were available, the transaction fees and monitoring fees, and the contract that I shown you earlier is part of that research. So for these companies, I found that it was a total of more than $10 billion. It was run as a front page story in the Wall Street Journal. The Wall Street Journal was very scared of being sued on that number because they found it too high, very high, and nobody complained. In terms of like putting it in as a fraction, the kind of amounts we are talking about is about 1.5% of the equity invested by pension funds every year. So that's the number. And then again, thanks to this transparency effort recently, the fund managers who are collecting these fees are returning most of them to the pension funds. So they are refunding them. So they are taking them and they are refunding them. The problem is that then now the pension funds are saying, okay, so now you can leave us alone because you see they are refunding us these fees. So just like, please just leave us alone on that. The problem is if you read the contracts, there are 4 pages of exceptions. So officially they refund everything like 100%, but there are 4 pages of exceptions and they are very hard to quantify. So that's again why the transparency fight is very important and it is a very difficult battle. Because you may say, okay, it's okay if they charge fees as long as I get refunded. I can write a contract that says, I will always refund you, just like you asked me, but, and I put four pages of exceptions, which in some cases means I'm going to hardly give you back anything. So the magnitude of the problem, we know how much the companies, US companies are paying. It's about 1.5% for one that were in my sample a year of the investment by pension funds. But we don't know very well how much is getting rebated to pension funds. So there's still a lot of unknown there. And there are all the expenses as well that we don't know and all kinds of other fees that they didn't capture in my research. But that's the kind of magnitude we are talking about. So it's not, when I say it's not mass tunneling, it's because there are some countries where like in India, in South Korea, we have seen tunneling, or in Russia, where like some people would take like all of the asset and run away with them. So we haven't seen that in the US. So, you know, again, you take these three big bankruptcies like Toys R Us, Energy Futures, and Harrah's Entertainment. Here, a total of a bit more than $1 billion was taken. The company went bankrupt, but you cannot really say it's tunneling on a massive scale. They didn't like take all the assets and run away. They just charged a lot of fees for something that was extremely vaguely defined services on top of what they were already charging pension funds. And so it looks a bit odd, but at the very least, we would just like to know how much they took.
Thank you. Mr. Bloom, you have a question?
Actually, I have 2 questions. Earlier in your presentation, Doctor, you mentioned that the average return on private equity is 12%. I assume that's minus the fees that they pay, that we paid, and the return to the GP would be about maybe 6 or 7%. And does that includes the carried interest?
Yeah.
Okay.
Yes, but again, we don't have then there are all the expenses and the like, but we don't know exactly how to quantify. But we know that at the very least, the GP took home 6%. Yeah.
The second question has to do with net asset value, and I think you mentioned this. I just wanted to clarify it. We're in the middle of an investment with company XYZ. We're 2 years in, and we are told the value of what that investment is on a particular at a particular time. I'm talking audit time. In other words, if we have $3-5 billion in private equity, okay, part of what we're being told is I'm sorry to use, because they have to use unobservable data. Okay, it's a guess as to what the net asset value would be on a particular company that a private equity would have invested in. Would you call that?
So it's an educated guess, yeah. On some assets, we are a bit more confident than in some others. It's a bit easier to value for like real estate. It's extremely hard for venture capital. In venture capital, like take like an investment in a very young company, like how much is it worth? And even if you have like an investor that recently bought a stake, like in Uber, and you'd say, okay, then implicitly it means it's worth 60 billion. Is that really? It's pretty hard to value. In private equities, in between, not easy to know exactly, what a private company is worth. So historically, people who have looked at the officially reported numbers and what happened next, on aggregate, there was no massive difference. So on aggregate, they seem to have got these numbers roughly right. But again, the issue is also going forward. So if going forward things are not going well, they would have a latitude not to report the true number, right? So when things are doing well and you report like the right numbers, then that maybe is a bit easier when things are not going well. So research so far has shown that the numbers are about correct. So you can be confident that as of June 2018, the number reported by your pension funds is about correct for the value of the assets that they have. It would be really strange if there was a discrepancy with the true value, market value. But again, it's an educated guess. It's important to bear in mind.
What I'm talking about, Doctor, is you talked about the $5 billion in California. Is that what we're talking about here?
Yeah, it is. Yeah, in my example, the 5 billion in question is the educated guess. So I think the situation in Pennsylvania is very similar. So you've given 10, got back 10, and there is like 5 still out there. And that if the 5 is actually being paid, then you have made 11% a year.
Thank you very much, Doctor.
Okay, Dr. Ludovic Philippou, thank you so much for your testimony. We are very appreciative. We will submit your biography for the commission records, and if we could be so bold and you'd be so kind as if we reach out again from our consultant, Dr. Ashby Monk, we might be in touch with you again to find out some more about your research. We appreciate your testimony here today. Thank you very much. We are grateful.
Thank you. It's my great pleasure. Thank you very much.
Terrific. Okay, the second group of testifiers will be from ILPA. So the Institutional Limited Partners Association, managing director is Jennifer Choi. Ms. Choi, prior to joining ILPA, was a research director for Emerging Markets Private Equity Association. And she was a consultant with Boston-based Stacks, Inc. Just let me tell you a little bit more about ILPA. They have approximately 450 member institutions representing more than $2 trillion of private equity assets under management. And they have got a template that we heard Dr. Philippou mention that he was helpful in helping to develop. And specifically, Act 5 requires us to pay attention to ILPA's work and their template and how they might help in the effort of transparency with, as I mentioned, a large number of institutional investors. So we are happy to listen to testimony from Ms. Choi, and we appreciate her presence and her expertise. And I think if we'd like, why don't the 3 testifiers of the group come up at this point in time, and then we'll move right on. I think we're scheduled for about 12 minutes from each, so we'll give a brief introduction before our other 2 testifiers get started. Thank you.
Well, good morning. Thank you very much. It's a pleasure to be here, and we at the ILPA appreciate the opportunity to shed a little bit more light on the work that we've done to advance transparency along with my fellow panelists. So the focus of my comments today will be to give you a bit of the background around our efforts to advance more fulsome and uniform reporting by fund managers to investors, which we call LPs, limited partners, providing some perspective on the adoption of reporting standards across the industry and its outlook, and as well as some observations on the efforts to legislatively mandate reporting standards for private equity. So you heard a little bit more about the association. Just to shed a bit more detail, we're actually at more than 480 member organizations across 50 countries, representing $2 trillion in private equity assets under management, or roughly about half of the global institutional capital invested into private equity funds. And ILPA, as we call it, is unique as the first and still the only organization dedicated exclusively to the interests of limited partners in this industry, and they constitute our entire membership. We do not count fund managers or other third parties among the ILPA membership. Our members include both public and private pension funds. In fact, that really constitutes our legacy membership. When we first got started about 20 years ago, the core were public pensions, insurance companies, university endowments, charitable foundations, family offices, and sovereign wealth funds, all of which are investing on behalf of beneficiaries, first responders, teachers, retirees, policyholders that are dependent on the investment returns generated by those private equity funds. And so core to our mission is the development of best practices such as the ILPA template we're discussing today that really empower our members to make effective and informed decisions about their private equity investments and to advance the quality of transparency and alignment of interest across our industry. So with that, I'd like to turn to give you a bit more history about the ILPA reporting template, as we call it in shorthand, and the transparency initiative that spawned it. I'm very pleased that my fellow panelists here were involved back in the early days of this initiative, but let me give you a bit of history. In 2012, ILPA issued guidance for the first time on reporting standards for private equity. We prescribed at that time what information managers should provide to their LPs about the underlying companies in the fund's portfolio, as well as information to be included in the capital calls and distribution notices. And I can certainly elaborate on that if needed. In the years that followed, the private equity industry became regulated for the first time. The industry had to, of course, adjust to that new reality. And at the same time, investor demands for transparency escalated for many reasons. We've heard Dr. Philippou talk about the influence of the SEC. Of course, I think you all are somewhat familiar with the political pressure on the industry and on investors, in particular public pensions, to rationalize the opacity and the perceived higher costs of the asset class. And then a number of SEC enforcement actions really brought to light some of the challenges around assuring that the fees being charged to investors do conform to the contract, the partnership agreement that really lays out how costs and profits are shared between the LP and the GP. But more importantly for us at ILPA, we were responding to a need that our members were articulating. They were sharing with us real pain and real challenge in answering legitimate questions. What does it cost to do private equity well? When we're thinking about optimizing the balance between external management and internal management, how should we think about what that would cost us? How should we think about selecting managers that provide us with the greatest efficiency relative to the net returns that they promise to the portfolio? And how do we make sure, again, that the fees that we're being charged directly or indirectly, netted out of distributions, conform with the contract that we signed? So in 2015, we convened a working group. At the core, the participants included a number of LPs, but in addition, we did solicit input from a number of third parties and experts to advise us on how to address this gap between the needs of the individual LPs like Lorelei and Renee, who were struggling to verify the fees being charged, and what the GPs were capable of doing and what could be the greatest and most widely adopted standard across the industry. So the template released in this timeline here, it's a bit small print, I apologize for that. But the template itself, after many, many months of deliberation and consultation with the wider industry, including the GP community, my colleagues and I should say, spent many, many hours. By our estimates, we did about 200 calls and meetings with LPs and GPs to develop this template, which was released January of 2016. And the benefits of the template were many, but I think one worth noting was a key challenge of a lot of our public plan members in particular was the fact that the reporting coming to them was being provided on an almost exclusively December 31 basis, often not called out in the level of detail that they needed, information being provided across capital call notices, footnotes to financial statements. And so shifting to a quarterly report that included all of the detail that I'll get into in the fees and expenses being charged, allowed individual pensions that had June 30 or March 31 or September 30 fiscal year ends for the first time to feel like they were reporting accurate information about fees and expenses in a way that aligned with their own institutional reporting cycles. The template also provided definitional clarity and itemized detail for offsets. Dr. Philippou addressed this a bit in his comments, and we will certainly come back to this, as well as common organizational expenses charged by GPs to LPs. And what we learned through the course of the initiative was, in fact, that the back office processes of a lot of fund managers were highly bespoke and highly varied. And so there was tremendous benefit to, for the first time, really laying down in writing how we define various organizational fund expenses. Last but not least, the fact that all of this information came together in a single format provides benefit, simply for the fact that rather than trying to hunt for individual data points across multiple types of reports, for the first time, it's all being provided in one place. But let me underscore the fact that responsibility for reporting standardization does not lie with the GP alone. This is an LP-driven phenomenon. This is an investor-driven phenomenon. And there's tremendous benefit to conformity of the ask coming from the LP to the GP. One GP may have 50, 75, 100, 150 different LPs. And imagine if each one of them came to you asking for a slightly different level of detail on a slightly different timeline. How challenging must it be to provide accurate information to satisfy all of those varying needs? So that single coherent ask really goes a long way in addressing those influence imbalances that Dr. Philippou mentioned earlier, the negotiating dynamic between the GP and the LP. It provides an incentive to the manager to comply with a single standard because it does offer the opportunity for efficiencies and economies of scale in technology or third-party service provider implementation and support for implementing the standard. So at the beginning, to talk a bit about the industry adoption and response. At the outset, many GPs were conceptually supportive. They got it. They understood that there were potential benefits they could realize through economies of scale, through a more uniform standard. But they were wary of the compliance challenges I mentioned a moment ago, presented by the level of detail in the template. Let me go back to that. You can see it in the background here. We're obviously not going to go into it in any depth. There's quite a lot of detail in the full version of the template. So managers who had to date not invested a tremendous amount in the reporting infrastructure or who considered themselves to have complex fee and operating expense models felt that this template was initially somewhat daunting. They were also concerned about the shelf life of the standard and worried that in fact, ILPA would be making subsequent revisions to this template on a cadence they simply couldn't keep up with, which would force them out of compliance. They were also skeptical that a one-size-fits-all template, which is what we were proposing, would be adaptable to the range of strategies and fund types out in the marketplace. And LPs, for their part, I wouldn't go so far as to say that they shied away from transparency. In fact, the number of endorsing organizations here belies that fact, but they did express some hesitation about the economic downsides to pushing for this template initially at the very beginning, such as being allocated away from by the GP. The GP's being told, we don't want you in our fund, either because of, again, the compliance challenges or for fear of having sensitive commercial information in the public domain due to Public Records Act requirements. So this fear of being outmaneuvered in what is still a very capital-rich fundraising environment did influence to some degree the pace with which LPs came on side, but as you can see here, they certainly have. And ILPA, for our part, has tried to emphasize the fact that we do not take lightly revisions to this standard. We know LPs and GPs alike and the organizations, the fund administrators, the service providers, the technology providers, the custodians have configured their systems to support this standard. So we certainly would not make changes without ample notification to the marketplace and thorough consultation about the import of those changes. So endorsing organizations here, you can see that we have 166 organizations in total that have endorsed the template. What does that mean? It means that they have signaled to the marketplace, whether they are a limited partner organization or a general partner organization or a consultant or other third party supporting this ecosystem, they have signaled that they embrace standardization and reporting, that they will provide this template to any LP that requests it, and over time they will integrate this standard into their reporting packages so that they can provide the standard to all of their LPs. A few brief statistics on where we are today. ILPA estimates that well over 300 managers are currently providing the template to those LPs that request it. By our count, 90% of our members are receiving the template from at least one of their managers, if not more. 26% of our members are receiving the ILPA template for at least half of their newer vintage funds. We know that endorsing general partners account for 26% of all private equity capital under management today. So to go back for a moment, where are we in the cycle? As I said, it's an inherently LP-driven phenomenon, adoption of a reporting standard. LPs have to introduce this into their negotiations with managers. They're not always successful, but what we find often if you're bringing it up in the course of a fundraising negotiation, when you're laying out the contract with the manager, either as a condition of your investment or as a line item in your side letter that accompanies your subscription to the fund, you may be successful. But more importantly, the more LPs that ask for this standard, whether they're successful in getting it into the partnership agreement or not, the more influence that has on the GP's willingness to provide it. And so we find that there is a tipping point. If enough LPs entering into a new fund are requesting this, are insisting upon it, are indicating that it is critical to them, the GPs are providing it. They are coming to ILPA and saying, my clients are requesting this. What can I do to comply? So we know that LP demand has an effect. As we move from adoption to implementation, and I know my colleague Lorelei will talk a bit more about this, LPs and GPs are now trying to figure out, well, what do we do with this information? How do we simplify and streamline the flow of data from the GP to the LP? And how do we equip the LPs to draw real insights from this information, including, and not least of all, of course, verification of the information being provided? So this brings us to a bit of discussion about public reporting standards. So this map is a slightly updated version of a map first published by the Pew Trust back in 2016, I believe. They really looked at CAFRs across all 50 states to see what level of disclosure of private equity costs was currently in play. And what they found was it varied quite a bit. But certainly the majority today are reporting pension investment performance after fees. However, when you look into the gross to net spread and the level of detail being provided state to state, it varies quite widely. Why is that? In part, it's attributable to their ability as individual investors, those pension plans, in acquiring the data from their GPs, methodological differences in how these CAFRs are put together and what is reported, and differing philosophies, as was mentioned by the previous presenter, about what should be considered a cost. Is carried interest disclosed or not? Is carried interest included in your fee load reported for your private equity investments or not? So there have been several attempts to legislate. We've talked a little bit already today about California and the law AB 2833, which passed and went into effect in January 2017. It applies to all contracts on a best efforts basis prior to 2017, but required for all new investments after January 2017. And it does not expressly prescribe use of the ILPA template, but the California plans subject to this law have indicated that the ILPA template meets nearly all of the requirements in the law. There have been reports of some managers who have elected not to raise capital from California plans as a result. We believe that this is a minority, but it is a critical consideration for legislators that private market investments are voluntary and negotiated relationships. And there will be high-performing managers that can choose not to take capital from certain investors. It is a very real consideration. And the most attractive managers, regardless of the market cycle, can take money or pass it up. So variance in state to state, as mentioned earlier, if one state decides to go it alone and be the only state to prescribe a certain standard, it may present challenges. It may mean that attractive managers elect not to raise capital there. It may mean that there are methodological differences that make benchmarking state to state or plan to plan challenging. And moreover, when it comes down to fund level benchmarking, where the individual pension may be looking to benchmark across funds, this may present challenges. So it begs the question, would federal legislation be a more optimal solution? And ILPA, for full disclosure, ILPA is in dialogue with the SEC on an educational basis. We learn from them, they learn from us. And so far we have heard that many of the challenges related to hygiene and compliance in GP reporting are addressed through adoption of the ILPA template. The agency's purview, however, is on the advisor and not the fund. So they are able to examine the advisor and examine the contracts attached to all of the funds managed by that advisor, but they're not able to look all the way through to individual contracts negotiated between the advisor at the fund level and the individual LP. So worth noting. So to date, support has been greater for encouraging adoption of industry standards for fund level reporting, rather than a regulator-issued standard that may be less adaptable to shifting market dynamics or market realities. A couple of cases in point: in the UK, the Financial Conduct Authority convened a group called the Institutional Disclosure Working Group last year. And that group deliberated on whether they could propose a single standard for the trustee that rolled up data coming from each of the individual positions in the portfolio across asset classes. And after much deliberation and consideration, they ultimately determined that the best course of action was to point to the ILPA template for private equity, although the mainstream asset classes did have various templates proposed by this working group. In Australia, the Australia Securities Investments Commission Regulatory Guide 97, that's a mouthful, RG 97, went into effect in 2017, requiring superannuation funds to disclose fees and costs in their product disclosure statements to investors. The Australian authorities have already signaled that it has been somewhat challenging to standardize certain types of costs related to real assets, for example. And one potential risk being that excessive focus on cost at the expense of returns might mean that there is some damage to the benefit to plan members. So, in conclusion, embrace of uniform reporting standards such as the ILPA template is critical to understanding costs and context. What is the benefit to the plan's bottom line? What is the performance of private equity investments relative to other parts of the portfolio, as we've already discussed? And are such comparisons being made on a fully costed basis? The next frontier, the holy grail, is benchmarking. But to get there requires uniform collection of data on costs. And we've made tremendous progress, but we really do believe that this uniform baseline for comparative analysis of net, fully costed returns, how managers achieve that performance, remains the goal. Thank you.
Excellent, thank you. We'll hold questions till the panel is completed. And who will testify next? Okay, Renee, that would be terrific. So Renee Aspen, investment officer at the $8 billion Employees Retirement System of Rhode Island. Thought it was very interesting. Oftentimes we hear about the confidentiality of information within agreements, yet in Rhode Island the information with these limited partner agreements is communicated via website, online, in about 85% of the instances, and I think in Pennsylvania we're probably more like the inverse of that, maybe only about 15%. So we're interested to hear the work that you've done in Rhode Island and why you felt that transparency was so important.
Well, good morning, and thank you for inviting me to speak today. I'm a senior investment officer with the Employees Retirement System of Rhode Island, part of a 5-person team that manages the defined benefit plan assets. My role includes overseeing our current portfolio of alternative investments, as well as sourcing new relationships and a number of administrative tasks related to those two things. I've also taken the lead on creating our fee analysis report every year since fiscal year 2013. I've served under 2 treasurers, and both have been laser focused on improving the health of our retirement system and also being a leader in transparency, not just in investments, but across all of Treasury. I'm here today to share the efforts and progress Rhode Island has made in implementing our own transparency policy and hope that we can be helpful to your process as you consider best practices on this topic. We are encouraged to see more and more of our peers making transparency a priority and are grateful to the ILPA, who has worked for years on establishing best practices in fund manager reporting, as it's had a direct impact on our ability to provide the best information we can to our constituents. We've worked extremely hard to provide fee and performance transparency especially, and I believe our policy is among the most comprehensive in the nation. So I'll show you what transparent Treasury looks like for Rhode Island today, but first I'll give you some background on how we got here. Our efforts in transparency started about 5 years ago, with the belief that Rhode Islanders deserve to know where their funds are invested and how they're performing. We had done a pretty good job of reporting on performance as well as direct costs in our monthly estate investment commission books, which are all published online every month. So we really wanted to focus on more fee transparency, as we had recently gotten into hedge fund investments, which are expensive assets, as well as we had always been invested in private equity and real estate. So in that light, in 2013, we created our first comprehensive fee report, which included investment management and performance fees from every underlying investment in the portfolio for the prior fiscal year. Our goal was to capture both direct and indirect fees. And I'll get a bit into the weeds here, so bear with me for a minute. But we defined direct fees as those paid out of our cash account when we receive a bill from the investment manager. There's an actual transfer of cash, and it's picked up by our accounting system. So those are easy to track. In contrast, indirect fees are those charged against our existing account balance, usually deducted from income or gains or cash balance at the fund level. So we don't receive a bill for it. There's no transfer of cash, and it's not picked up necessarily by our accounting system as an expense. However, it is still, the fees are still reflected in our values because we're reported the values net of fees. Still, it was important to us to establish and to report on both of those types of fees in our analysis to create a true capture and true picture of what we're paying for our investments. This was not easy. As Jennifer mentioned, there's no uniform reporting standards among most alternative investment asset classes where a lot of these indirect fees lie. So we have over 100 funds across private equity, real estate, hedge funds, and quarterly statements to look at for all of those, with also audited annual financials, and our fiscal year ends June 30th. So it was quite a heavy uplift, but we were able to, after a few months of work, create our first report. And the first report we published on an asset class level. So it included underlying fees for every fund in the portfolio, but we showed it on an asset class level to the public and put that on our website. We wanted to go a little bit deeper because we were getting some questions related to hedge funds, which were a newer asset class for us, and as I mentioned, quite expensive. So we asked each of our hedge fund managers if we could publish their fees as well, line by line, also on our website. We wanted to do management fees and performance fees, and we wanted to show both the term, so usually 1.5 and 20 or 2 and 20, as well as the dollar amount that we paid them in that fiscal year. After several conversations with them to get them comfortable, we got consent from each of them. They didn't have to give us this consent because this information they could claim was protected by confidentiality, but they worked with us, and we were appreciative of that. In subsequent years, we did the same thing with our other asset classes, which took a bit longer, but private equity, real estate, infrastructure, and then all the publicly traded funds, we began to report line by line on our website. And with those as well, the managers, we had overwhelming support. So over 85% of the funds gave us their consent. Although again, they could have held up, and some did, claiming confidentiality. In 2014, we also began to publish performance on a fund-by-fund basis, and it was more calls to those managers to make things more difficult for ourselves. So it was a very intensive process to get to this point. Again, similar results where over 85% gave us their approval to publish line-by-line performance, and this was on a quarterly basis. Most of the funds that did not comply were legacy venture capital funds that were more secretive, and even since then, though, some of them have come around where the first year they did not want to give us their consent, and since then they've been receiving this request from more and more investors, and they realize this is the way the industry is going, so a few of them have come around as well. And when Treasury Magaziner took office in 2015, fees and transparency were becoming more and more relevant to investors across the country, and there seemed to be an inflection point. So in 2015, the Treasurer and the State Investment Commission decided to create the Transparency in Government Agreement. So that means going forward, any fund that wants to do business with Rhode Island must agree to the disclosure of their fees on an annual basis and performance on a quarterly basis to be published. We also launched Transparent Treasury, which you'll see in a minute, and it's a more robust reporting effort on our website. We call it Investment Information Center. So going forward from 2015, every manager must sign a transparency agreement even before coming before our committee to present for approval. We had already had them sign Investor Code of Conduct, which relates to political contribution laws and ethical standards, and they also already had to sign a placement agent disclosure certificate. So any time they work with a placement agent, they must disclose their relationship, and they must confirm that they did not pay this placement agent in connection with Rhode Island's investment, but at a firm level to raise their entire fund. As I mentioned, some of the funds are still grandfathered under the old policy, but some others have come around. And we would say that we have not, this policy has not limited our ability to access funds. As Jennifer mentioned, this is the way the industry is going. So more and more investors are asking managers for this information and making it public increasingly. So it's made our job easier in terms of gathering the information. We believe the reporting's gotten a lot better, as well as their compliance with these issues. We see this happening across the country. And we definitely speak with the managers early in the diligence process about this policy to make sure that we don't get to the end and want them to present to our committee, but they're not comfortable with disclosing. So we make sure to talk about this from the very beginning. We realize public pension capital represents a significant portion of institutional assets, and we're an important part of the private investment ecosystem, so we have the right to ask for this information. The good news for you guys is that since we began with this in 2012, the process has become much easier, again, thanks to the hard work of the ILPA, which has established a reporting template for private investment managers. It has everything we need to complete our fee reporting, and we encourage managers to use this template. If they choose not to use it, we still require that they report these fees to us in some way, quarterly. I would say that our policies also helped us when we get public records requests. A lot of time they're looking for detailed information on our underlying fund managers' performance, such as private equity and hedge funds and real estate. And with our reporting and our policy, we can point them to our website because everything is there for them to see, which I'll show you in a minute. But it's made things easier from not having to compile reports every time we get these requests, which are frequent. We believe that asking for this information from fund managers helps with alignment. It shows them we're paying attention, that costs are important to us. We believe it improves communication and reminds them who they're working for at the end of the day. It's retired teachers, public safety officers, and public servants who are relying on the retirement benefits. So I'll show you a couple of views of our website. Sorry that it's small for people in the audience, but on the left side of the screen, you see the dashboard. When you go to investments.treasury.ri.gov, this is our dashboard. And we've got tabs for information on our policy, on our asset allocation, investment manager directory, and then performance. Below, in the middle of the screen, we've got tabs for performance, asset allocation, and investment expenses. So here on the left side, this is what our asset allocation page looks like. It's got, it drills down all the way to our asset categories there, and you can see the percentage of the plan that is targeted in each asset class. On the right side of the screen, the bottom represents our net asset value over the pension over time and cash flows over time. So those are the benefit payments that are going out. And there's the ability to toggle over different periods of time. Left side of the screen, again, on the bottom, it's net asset value and then performance over time against a benchmark of 60-40, and our policy, our plan benchmark, which is made up of the sub-asset class categories. The right side of the screen is the first page of our fiscal 17 expense report. So this is what it looked like the first year, and this is what it looks like today. Today, you'll see after this page, if you're on the website, you can scroll through several pages, and it's got the underlying fund manager data. So the first column all the way to the left is every asset class in the portfolio. The next column over is management fees. And then we have fund expense, which I forgot to mention. Fund expense, we started recording a couple of years ago, and this is something that the prior presenters talked about. It's those other operating expenses that the managers are charging us. So anything like fees are paying to administrators or for the audit, legal fees, accounting fees, things like that. And then the third column is performance expense. So carried interest goes in that column. And the final is the total in bold. And then on the right-hand side, that's the expense ratio for the overall plan. So that's the top half of those is investment expenses, and the small piece on the bottom is just other operating expense for our investments department. So money that we pay our lawyers or that we're paying for research, any databases, our custody fees, and our consulting fees. And then we have an investment manager directory on our website, which is on the left side. So for every asset class in the portfolio, we have, you can click on the tab, and then we have a little blurb on each manager in the portfolio. It's just got some basic firm information, and we've asked the managers for permission. That's part of the transparency and government agreement. They agree to have us put a little blurb up about their firm. And then the next two pieces, we put information on how much we've committed to these managers and when, and what part of the portfolio it goes in. We've got some proxy voting statistics on the right side. And finally, transparent treasury is the law in Rhode Island. In 2017, at the request of Treasurer Magaziner, the General Assembly enacted Rhode Island General Law 351015, which basically makes that transparency and government agreement part of law. So in future administrations, when Treasurer Magaziner is no longer there, it's still law that we must be able to disclose this information for all of our managers if they would like to do business with us. I'd be happy to answer any questions at the end, and would like to let you know that we'd be happy to serve as a resource for you guys on this in terms of creating information on a website or the construction of fee reports. Happy to be a resource to you.
Renee, thank you very much for your testimony, and thank you for leading the way in transparency, you and your team in Rhode Island. I want to submit for the record, Glenn, and I'll give this document to you. It was worked on by the Treasurer's Office, specifically Lloyd Ebright. We've got a list of websites of pension funds or investment boards with notable transparency practices, and Rhode Island is among them, as well as South Carolina. So I'll make an introduction to Lorelei Gray, founder of Independent Consultant, the Independent Consultant Group, Leah Doran Financial. So Lorelei is the founder of that group. And formerly, she was a reporting officer for the public retirement systems in South Carolina, where Lorelei spearheaded the state's development and implementation of the annual fee collection, validation, and reporting process, which was featured in a prominent CEM benchmarking study. Thank you so much for joining us today and your work in transparency.
Thank you. It's good to be here. So I appreciate the opportunity to address the Commission on this important topic. It is all about alignment and transparency and reporting. I don't take the task lightly, and I have a great deal of respect for the process that you're embarking upon. So I understand that the document that I had prepared has already been distributed so that you have that there. I did not bring slides. A lot of the information that I want to communicate is more so with qualitative and with my words. So at the risk of making this topic sound overly simplistic, I wanted to boil down in that document the ideas around reporting and transparency to concepts that will be easily remembered, because I think painting a picture is more important when we're talking about the types of topics that the information that I want to convey here today. So I hope that I can be respectful of our time frame, and I look forward to your questions at the end as well. Transparency is a word that we hear every day in government and around the globe. It's very important, but what does it mean to me and to LPs in private equity, and specifically to public pensions? Well, we've heard lots of information already this morning, and I think that probably the best way to boil down what we're after in reporting as institutional investors, as LPs in this space, can come to three three topics. One is consistency. Two is granularity, and these are all words that I know you've already heard. And the third one would be depth, or sometimes I like to appropriate that physics term, optical depth, because I think it paints a better picture of what we're after. The reason that consistency in the incoming information is so important is because of the volume of information that investors are having to accept, to collect, to process, and review or analyze. I did a quick review online of the latest CAFRs that are available on the state employees and the school employees here for Pennsylvania. I think on a quick count gave me around somewhere in the neighborhood of 600 private equity commitments, 550 to 600. That's a lot of investments, and it's a lot of information coming in. So as you can imagine, something that's already been touched on, I think, by Jen Choi here today, was that a lot of public pensions, we have a fiscal year ending on, say, June 30th, and a lot of the information that comes in the door that's the most detailed is on a calendar year. And we need that information on a quarterly basis. So that's one of the reasons that the ILPA template was so important. And if you can just imagine what it's like when you have 600 statements coming in the door every quarter across these two pensions, and the staff that needs to be able to consume that information, use it for reporting, use it to make decisions upon, it's going to be extremely important that that data is consistent. The other part is that it is also granular, and I love this term granularity because it conjures images of like little grains of sand, because what we're talking about is getting it down to the most basic categorizations. So if you have consistent information and it is in a detailed format, that those are two very important keys to having reporting that can be consumed, can be potentially in the future automated without an extensive amount of manual work, and then also be comparable, sliced and diced and reviewed, and at the level of your portfolio as an investor. Optical depth, that's an important term, I think, mostly because we have to be cognizant, we have to remember that what we're talking about here today primarily are cost, fees, carry, fund expenses that occur at the fund level. And the fund where these pooled assets are, they own these portfolio companies, these operating companies. There's other transactions at lower levels that have other data points. And we're really focused mostly right now when it comes to this idea of transparency is capturing what occurs at the fund level. Now, there are some things that occur at lower levels that have impact, like what we call rebates, which are charges that occur at the portfolio company level and that many times are negotiated in our LPAs to create reductions to the management fee as a rebate. So those are the 3 points I wanted to make sure and convey here today. At the portfolio company level, I don't want to get too far down that path, but there are other data points like our total costs, our remaining value, static attributes like the geography, sectors that these companies are in, even the underlying operating details that investors like to know to understand value creation, and that's like revenue, EBITDA of these operating companies. But the big takeaway here is that transparency truly is a multi-tiered effort. Investors are pushing to get, for purposes of disclosure and transparency, better, consistent, and granular information at the fund level. But on the front office side, many times we're also trying to dig further into the portfolio company level. So it's kind of important to remember we're talking about almost sort of two different layers here. But today, I think the most important thing to convey is that that the folks on the front line of this topic, if you're on a reporting team or the accounting team for a public pension and you're trying to process this information and create the fantastic reports and the websites that we've seen Renee demonstrate here today, Rhode Island really has taken it to the next level. That information needs to come in a more streamlined fashion. It's the lack of standardization, the inconsistency in reporting from one fund to the next that creates a lot of the hurdles. Because if you saw in the report that I've provided, there is a comparison And if you saw this page, it looks like this. It's a very simple page here. It has example A and B. These are the line items taken from two actual, what we call partners' capital account statements, these quarterly reports that we get. These are two different funds, actual line items that are listed there. They convey the same information. As an investor, you see your beginning net asset value or market value, the changes that occurred within the quarter, and then the ending value. But you can see that one has far more granular detail than the other. And in order to be able to analyze, compare, and in the future, as Jen mentioned, the Holy Grail benchmark, we've got to get to more granular and data and a consistent level from fund to fund. And that's only going to be accomplished through a collaboration or coalescence around this push for greater transparency and best practices, such as the ILPA template, which puts this information not only into a prescribed set of data points, but also in Excel in that case. And Excel was very important because it takes us away from what currently investors receive, which are PDFs, the electronic portable document format that you can look at and print on a screen. That does not facilitate easily automation, easy consumption of this incoming data from, say, 200, 300, or 600 different investments every quarter into your own portfolio analysis tools as an investor, right? We have to move towards digitization, and that's what I'm very focused on today, because the ILPA template was one of the primary focus was that as one of the contributors to this effort, we were very interested in making it an Excel form, an Excel sheet, so that it would facilitate the investors who needed to be able to import this data, either through their service providers or themselves into their reporting tools. And I saw Excel as a step along the way to the future state, which I believe is digitization. A lot of my role in the industry today, after some really great experience with a strong team at South Carolina, I'm very proud of our team and what we did there. But a lot of my work today is a dual role. I have a commercial function. I serve vendors in the field, investors, and even sometimes asset managers. But the other side of my role is this industry initiative work, whereby we're trying to build consensus. Some people have even called it evangelism a bit in the field, which I kind of feel like that person sometimes, preaching out there about what we can do, what we can accomplish together. And the reason that that's so important, as Jen mentioned, ILPA, for example, representing 480 institutional investors, over $2 trillion in assets. There's a lot of power in numbers. The current market conditions mean that investors are chasing with their dollars in many ways, the best deals, the best funds, the best managers. But the tables, the way the economics work today, we do run that risk of not being able to get into the funds that we want sometimes. And so by standing out as the most demanding and most difficult investor, we run that risk occasionally of not being able to access those funds that we want. So it's important that we build consensus in the industry and that investors are able to work together, like by endorsing best practices and then helping to implement those. And when it comes to the implementation, what that means is not customization of a best practice, not modifications of standards, but ideological and realistic adoption and implementation of those standards, because those, a best practice, it is only effective when everybody can use it. And when we begin to modify a standard, what we do is we eliminate the carrot, the opportunities for scale and efficiency which we have to utilize to sell on the GP side of the equation. Because as Jen mentioned earlier, they might have 100 different investors in a particular fund, and if 100 investors want a template or a standard with modification, then they're not going to be as excited about any best practice that we bring forward and say, here's what's going to move us towards that end state in the future. So the most important things, though, in that document, by the way, I mentioned a couple of the hurdles. Early on, we did run into a lot of reluctance, investors worried about becoming a difficult investor. And I think that what I found was that GPs generally were willing to work with them, especially if there were opportunities to automate or to stick to one template. GPs, the sensitivities that I saw were about, what are you going to do with the information, and who is it going to be shared with? So I think we can also, when it comes to FOIA and Public Records Act, I think it's very important to strike a balance. We obviously can accomplish, based on what we've seen with Rhode Island today, we obviously can accomplish a great level of detail and transparency. But I would want to remember that some of the information beyond costs, down into the specific strategies, maybe the confidentiality of the deal terms themselves, our LPAs, maybe specifics into how GPs create value. What do they do at the operating company level? Those sorts of details might be considered more confidential and proprietary. And I don't know that those details serve us in the transparency effort as much as what we're accomplishing here with things like the ILPA template. So I don't think that that's where we're going, but it's always important, I think, to remember that in any effort like this. The future state is going to be uniform. I'm looking for my notes here to make sure I don't get too far off track. But uniform collection of costs details. And ultimately the goal is to be able to benchmark this information. And efforts such as this do continue to push the needle forward for transparency and alignment of interests, because I think it is prudent as investors to be able to measure our costs and to be able to manage them. And the most important thing when I think that we need to remember when it comes to cost is that fees, the amounts, they're pretty high. The asset class is a higher cost asset class. And we can take that information out of context. So we need to remember that in context, what are the returns that are generated, and how can we benchmark this information? How can we look at it across the portfolio and make apples-to-apples comparisons? Because, frankly, the numbers are so big. And when we're talking about investing on behalf of thousands of beneficiaries, the relative size of these numbers can be alarming. And so that's why I think it's very important to keep this information in context. I think that one of the most important things is to enable your pension staff to do their job and to do it well, and be able to access information, and to be able to be transparent at the same time. So I hope that those are things that will be taken into consideration. The only way that we're going to achieve the future state that we're talking about is through consistency, which is basically standards or standardization of reporting, and through transparency and sufficient granularity. Now, this information, as we get better information, it becomes more useful over a period of time. So looking at information also as a snapshot at 1 year or 1 quarter isn't as useful as being able to look at it comparatively over a period of years that more aligns with the life cycle of private equity. So those are some of the things I wanted to highlight today. Probably the most important takeaway, though, is that endorsing and encouraging the implementation of best practices is the best way to go. And I hope that I hope that this information has been helpful, but I look forward to your questions.
Thank you. And many of my questions have been answered through your testimony. I appreciate it. It's really very thorough. I'll mention that House Bill 1460, one of my colleagues, Representative Brett Miller, has in that legislation required that we adopt the ILPA standards. And I just want to make a note that we've got from our Appropriations Department a cost associated with that of about $300,000, I think, a year. As a matter of fact, it may be $600,000 with both of the systems, and then the Independent Fiscal Office, who offers actuarial notes on pension, they said that it's a de minimis cost or nothing. Can you tell me about the cost of implementing ILPA standards as you see it?
I guess if I may ask a clarifying question about the estimate, is there any further detail you could provide on the 300,000 or 600,000 estimate, what's included in that?
Yeah, so I read the fiscal note, and I think the systems came back and said it would require additional staff.
I don't have precise estimates for what it costs other endorsing organizations that have really put best efforts into implementation of the standard, but that seems reasonable, and I do believe for the most part, if there is a cost to any implementing LP, it is staff to make the phone calls that Renee and Lorelei made to the managers to secure the data, to follow up on any discrepancies or gaps in the reporting. And then a piece that we haven't really pushed on in today's conversation is the systems, the technology investments required for warehousing the data in a way that allows you to do what we're talking about, track between managers and track the information over time. So to the extent that that's not included in the estimates you've been provided in the fiscal note, I would say that is a cost that some of the larger pension plans that we know have endorsed and adopted the template are encountering now.
Great. Have you gotten any feedback from the plans that have endorsed it, the standards or the template, and seen that they may have benefited from lowering fees?
I think that there's been probably some marginal decrease in fees going on for some time because fees and lowering fees has been a real focus of the negotiation. So to the extent that you can get the headline management fee down, conventional wisdom is that it's 2%. I think no one pays in actuality 2%. I think it's probably closer to 175 basis points for the most part, although we still talk about a headline management fee of 2%. But I do see that the offsets, we talked about offsets being applied. So fees charged to portfolio companies that are subsequently offset against the management fee. We've seen those offset ratios increase, so that's also resulting in a lower net fee. And in addition, I think the more visibility LPs have into those partnership expenses, so all of the costs that fall outside of the management fee, but that you still pay for the most part either directly or it's netted out of the distribution back to you on the return, the more granularity you have on those, the more you can push on that in a negotiation. So we don't have evidence of that, but I think all trends point to the fact that LPs are benefiting from the transparency and granularity.
Great. So without the requirement, I want to be quick because we want to be mindful of time. But, based on the information that you have, I think that both systems have endorsed ILPA, but how do you think they're doing with utilizing the template and their overall
I would hesitate to venture any sort of a guess as to how exactly they're using the information since I'm not embedded within the staffs, as Lorelei mentioned, the frontline staff that are getting the data and what they're doing with it. But I think for the most part, the focus today is on acquiring the data and verification against the partnership agreement. So looking for outliers, looking for things that look a bit off so that you can follow up with the manager to make sure that you have an accurate understanding of the costs.
Sure. Thank you very much. Joe, questions?
Thank you. And I want to thank you, Ms. Choi, Ms. Gray, I understood more clearly today something that I didn't get before, which is why the ILPA template is so important as opposed to simply trying to get the information. The real power of this is in the standardization, which is probably why ILPA, as opposed to some vague industry standard, was specified in the legislation that created us. And I do want to explore how we do that. One of our systems is requiring it, the other isn't, but I think that'll wait till their hearing. But thank you. Just a quick question in the interest of time, and a hello to my colleague, Treasurer Magaziner. Why was it important to you to have the data public as opposed to simply to your trustees? And do you believe that you've lost significant? Do you think the trade-offs of possible some lost exposure to some managers, don't know where they're performing, has been outweighed by the benefits of transparency?
So I think it was important for us to publish our fees because, we were already, we were, the portfolio and portfolios in general have become increasingly complex with different asset classes, and it's a lot more than the standard few basis points for, public equity indices that investors are paying these days. We don't have anything to hide from it. We think that we pay more for private equity because it's been our best performer over the long term, and that's true, still today. And so we don't have anything to hide from it. And we also just think that's really important for us and the public to understand what those costs are, and for them to know that we know and that we're asking for it, and that we understand it, and that we don't have any misconceptions about what we're paying, and that we're holding managers accountable for it, and we're holding ourselves accountable by asking for it and by reporting it. So it was important to us because also we started with the hedge funds, and we thought, why not do it for the rest of the portfolio? It gives everybody a complete picture, that we've looked at every line item in the book and have assessed the fees, and are holding on to those investments and continue to make new investments because the performance has been positive, very positive. I also think it does help getting ahead of these public records requests. We're spending a ton of time responding to them, and we'd rather spend our time on investing, and that's our fiduciary responsibility. And so, if we can produce these reports, and now it's become quicker with things like the ILPA template. If we can just kind of get these more automated and get better at it and get quicker at it. They're out there now for everyone to see. So we don't need to keep producing these reports every year or customizing them per the request. Everything that they would need that we believe is public information is out there now. And the rest of it we've determined is proprietary. I don't think that we have never had a manager say, well, my colleague said a couple years ago, he was at a conference talking to a venture fund, and they said, what are your disclosure requirements? Okay, we can talk to you, but we're not going to take your capital. He said that was a couple years ago. And other than that, and then we had a couple of funds that we were invested with that didn't consent to our disclosures. But other than that, we've never had a manager, turn us away during a conversation based on our requirements. And I think that they realize, they have other public capital, and I don't think that they would be able to lose that investor base. Public pensions are, as I mentioned, a significant portion of capital in the industry, and we hold a significant portion of many funds. There's probably funds out there that have endowment and foundation capital, and we probably wouldn't see those. We may not see those funds anyway, or they wouldn't market to us anyway. But no funds that we've been interested in accessing have had an issue with it.
That's good to know, especially because there's some overlap in funds you hold and we hold.
Yeah.
That's great.
Yeah.
Commissioner Torbert?
Yeah, I just wanted to comment. I spent 34 years in the investment business, vast majority of that time as a senior investment officer in a trust department for different banks. And we always had that fiduciary responsibility, and my clients constantly asked me about our fees. We had account level fees, or we had, because we were fee-based, or we might use no-load funds or whatever. So we'd always have to let them know about that too. And I think it's great that you're all doing this. I think you should continue. I always looked at the limited partnerships and things like that kind of slanted with a slanted eye, because you never really could tell where all the fees were coming from. And I started this in 1984, so you could imagine what it was like back then, or maybe you can't. And being a fiduciary is very important. But I was always on the personal side, not on the institutional. And clients every year wanted to become more and more aware of what their fees are. And I think that's great, and I'm glad you guys are doing it. Keeps everybody honest, and hopefully we can get better returns for our clients as well.
Thank you.
Thank you, Mr. Nichols. Do you have a question?
Yeah, I'm curious about Rhode Island. Does your law specify ILPA?
It does not. No, it just specifies that the information that we're going to be disclosing for each fund is they're basically the fee terms for each investment. So management fee percentage, performance fee percentage, dollars for each of those, and expenses, and then net IRR and net multiple invested capital performance. It does not specify the ILPA though.
Now, I believe you mentioned that some of your GPs didn't want to use ILPA, but you accepted other types
Yeah.
that were equal. what is the biggest pushback you got, and was it legitimate in your opinion?
I would say some of the pushback was from funds that were much older, so we just have a small dollar value left in the fund, and their thought was, they might be using the template for their newer funds or going forward, but they didn't want it to put the time basically into providing all this information on a very old fund that will probably be wound down the next few years. I'm trying to think. There may have been another couple of funds that are just smaller. We try to invest in some smaller and emerging managers, and it's kind of, some of them actually are fine with it and provide it for us and did it right away, and the others, so I don't know that they can really claim that it's a resource issue, but some of them just said, we're not at that point yet. We'll give you the information that you need, but we're not at that point where we're going to produce this report, everything in here. So as long as we get what we need, we're okay. But we do notice more uptake on the template. It's much easier for us. It's also easier for our custodian bank to then record those fees.
So it sounds like your approach is similar to what I understand California's is, where they try to use ILPA, but as long as they get the information, they'll accept.
Yep. Correct.
Thank you.
Can I add something to that? Just because I ran into that as well. And sometimes there's an initiative I'm working on. It's a cross-collaboration in the industry called the ADS, or ADS Initiative, which means Adopting Data Standards. And it's bringing together commercial firms who want to do a proof of concept to demonstrate the feasibility of automation and adoption of data standards. And one of the things that I think was very important about the ILPA working group bringing forward the template was that we looked at it, and Jen can back this up. We looked at it as a prospective standard. So on older funds, the granularity, that concept that we were talking about, many times was not there. There would have to be manual efforts in order to accommodate the different line items that were in the ILPA template on some of the oldest funds that may not have had the detailed reporting. So in those cases, sometimes, yes, investors have had to accept a minimum standard rather than require an older vintage fund without such detail to fill out the full ILPA template. And that's not an unreasonable accommodation, I think, in an older fund at all.
Thank you, Commissioner Bloom.
Just a couple of things. First of all, excuse me, of the 600 plus 550 to 600 funds we have, I don't know how many there are that are old legacy funds. Some of them have as little as $100,000 and $2.5 million, and very, very small. And I don't know what how to clean those up, or if it's necessary to clean them up, or whether it seems to me that the reporting on a $100,000 fund would probably not be worthwhile. The legislation that Rhode Island has passed requires those three things: the code of conduct, what is done with the placement agents, reporting issues, that you tell potential investors before you interview them, and do you use a consultant as well?
We do use a consultant. The legislation is only relates to the transparency pledge, not the placement agent and code of conduct. Those two forms, that's more of an internal policy, or a policy for our state investment commission that they've established years ago, probably in 2011. So the legislation only relates to the transparency pledge, which is the disclosure of fees and performance.
Okay, does that mean that you cannot or will not sign a non-disclosure agreement? Or do you make exceptions?
You mean as we're doing diligence on a fund?
Non-disclosure of fees? Would you sign?
We will not sign that. No, we will not sign those.
Yeah, I guess if we get to the tipping point at some point when fees are transparent, then I think competition will start, And I think that's really what the direction that eventually we'll get into this business of private equity is competition. Because if you're not telling anybody what you're charging, certainly Rhode Island would like to know what our deals are, if our deals are a lot better than yours, or Iowa, et cetera, et cetera. So hopefully at some point we do get to the point where all the fees are transparent and people can start to compete. Thank you.
Excellent. And as a follow-up question, Commissioner Torbett.
Are you able to collect gross of fees and net of fees?
Performance?
Yes, performance.
Yes.
Okay.
So we're making a better effort to collect gross of fee performance now, because with the addition of these, so with this reporting that we're trying to do, where we're trying to get these indirect fees, once these start flowing through our accounting system, that will increase the gross of fee performance. But we always do report gross and net of fees when we can. But our report is just net of fees.
I've always found that very helpful in the investment business. One of the organizations, we had GIPS compliance, and we could see either gross or net of fees. And when you're talking to a client, well, when I was talking to a client, it was very easy to explain how the fees work and how they related to gross and net. That would be very helpful.
If I could just say, across our membership, getting gross of fees performance is not yet the standard. So a lot of LPs are doing exactly what Renee and her team are doing, trying to build it back up from the net figure generated with the additional transparency around the fees charged.
Excellent. I want to thank you again. We are grateful for your testimony, and I'll make the same request as I did with Dr. Philippou. If the commission could be, and its consultant could be back in touch with you with any further questioning, it would be helpful in our endeavor. So thank you very much.
It's an honor. Thank you.
With that said, we are due for a break, and I think our agenda says back at 12:30, but why don't we just extend that to 12:35? We'll do 5 minutes. We ran 10 minutes over. We'll do 5 minutes, push it back for 5. Okay? Great. Thank you.